the biggest barrier to successful homeownership is not income, it's superfluous spending. So if you've kept your spending in check and now you feel disciplined enough to where you're like, you know what? I put 5% down on this house 5 years ago and now I've got 15% equity. Maybe I should refinance into an all-in-one and attack the heck out of my principal, keep my spending in check.
Welcome to the Top Tier Podcast, where we take you to new heights in the world of real estate, capital raising, and business entrepreneurship. Meet your hosts, Daniela and Landon, industry experts passionate about success. Join them on the Top Tier Podcast as they share real-world experiences, practical solutions, and strategies to overcome business and real estate challenges. From expert interviews to actionable advice, they aim to inspire and empower you. Subscribe now to never miss an episode.
Hi, everybody. Welcome back to Top Tier with Landon and Daniela. We're super excited today to have Matt Bell on. He's going to talk to us about all things lending and his borrow better lookout for the future.
No, I'm so excited for this. I think on this podcast alone, I'm going to take more notes than any other podcast we've done or recorded because there's so many nuggets that we're going to be able to take and implement into our world and our business, and not only just real estate acquisition, but just other opportunities and various, not only just like your standard vanilla loan products and whatnot, but some other alternative things that maybe some loan products that we're sleeping on that we need to implement into our acquisition strategy and future things. And then also too, just getting to know someone in the industry that you can call up and reach out to, who is a tremendous resource and so knowledgeable. I'm so excited for Matt Bell to join us today. Yeah, let's bring him up. Welcome, Matt.
I feel like I need to have some sort of like walk up to the plate music. You know?
Yeah.
We're so grateful that you're joining us. And you were saying to us a couple minutes ago, it's your first podcast. I don't know how that's possible.
First formal, no time budgets, nothing is off limits kind of first podcast. I mean, I do like co-hosted YouTube video, either live sessions or recorded sessions where there's like a set of questions. And obviously I have time to prepare, curated answers, but those kind of videos help you hone your skills for when it's just ad hoc, which this is, and I'm excited.
Awesome.
Yeah, I prefer it that way. Just more just conversational. I want to get to know you at a conversational level. It's not scripted. It's not planned. It's, there's certainly space for that, but I want to get to know you at a deeper level you and I built a relationship of over the past 18 months or so, doing various deals together. And you've been a tremendous resource for me and my ventures in the real estate space. But I want to go back a little bit here for the people to get to know you at a deeper level, that some things that maybe I didn't know, but I know you have 6 children, which is amazing and fascinating because you look 31 years old. I know. You genuinely do. I remember when you came out here to Phoenix and you spoke at the real estate meetup we hosted. I was blown away that you looked younger than I do. And so and you had a nice suntan. You were having some nice cocktails. You're having a great time and you're so full of energy. You're infectious to be around. I just love being around you. And you're super smart. And so there's so much love for you, man. Thank you for joining us.
I'm honored to be here.
So I don't know you as well as Landon. And I come from a family of small business since the 60s in San Francisco. And I'm always curious how people start in small business. Like, we know that you're a technician at what you do, but where did that come from? Where did that start for you?
Oh gosh, that's a good question. Wow, you just throwing strikes down the middle, aren't you?
You're going in.
Here's my thing, and I think that the tactician, the technician, the attention to detail came probably later in life as more of a self-protection mechanism. And what I mean by self-protection is I've gone through from my early teenage years. I got married at 19, and that's why I have a 21-year-old at 42 years old. Got married at 19, had 4 kids by the time I was 24, was making a crap ton of money into my mid to late 20s, and I had no idea what I was doing with it, and I made some poor decisions. And I felt like kind of had to a rebirth of what it was like to even be a basic, mature adult man in my late 20s. And
Wow.
I burned a lot of bridges through bad decisions. I had a lot of bad decisions heaped upon me, a lot of heartache, a lot of heartache. And so what I found in my early 30s is if I can get really detailed at a skill set or a vocation, I'll save myself heartache, financial heartache more than anything, and I'll help others save financial heartache. And so I think if I could pick a month and a year where my life changed business wise, would be November of 2012. I think I told Landon the story. I don't know if I did. Obama had just won re-election. He had defeated Mitt Romney. I was 60 pounds overweight, sort of coming out of like a 6-year depression. And it all started, this is so weird. It all started from a guy at work who was really good at guessing weight. He's like, Belle, I bet I can predict or I bet I can guess your weight. I was like, go ahead. And he guessed it, and it was embarrassing.
Oh,
And so that night, I lived alone. My kids, by that point, were with their mom and new boyfriend, new husband, whatever. And I was a bachelor living in a really nice apartment. I went home, cleaned out my refrigerator, and started watching The West Wing on Netflix. And The West Wing came out in 99. So I was a senior in high school when it debuted on NBC, and I'd never watched it. I just heard it was kind of cool. And I think I watched the first 3 seasons like all night from like 6 p.m. until like 4 a.m.
Wow.
And I got addicted to knowledge, the deployment of the knowledge, not to make yourself look funny and cool, although there are those bits and pieces of West Wing that are like that.
Mm-hmm.
But I would literally watch this show, and the character that plays the deputy chief of staff would talk about FHA and HUD in the White House Situation Room. And I was like, I'm in housing. I'm in mortgage. I work for the second largest bank in the country. Why do I not know this stuff? And it literally was a switch. And the next day, I bought like $3,000 worth of online or physical books about law, about housing policy, about FDR, launching FHA. And I just learned everything I could in as short amount of time as possible. I almost went to law school because of that. I just, like, it was almost this fire inside of me, like, was raging with this hunger to learn how the world worked. I didn't want to learn just to be the cool guy at cocktail parties. I wanted to learn, where does a dollar go when I deposit it? How does it make its way through the financial system? And how did that dollar get printed? And why does that $1 buy me a candy bar now, but it bought me a loaf of bread 5 years? That kind of stuff was fascinating. And so that started me on a journey of becoming the smartest guy at work. Within 6 months, got like this big promotion at the second largest bank. And then I always had a love for sales. I sort of stepped away from originating during that 6-year depression because I wasn't, a good salesperson during that time. And so I got back into sort of the management of the origination side and learned how to breed behind the scenes knowledge and bring that to bear for clients. And when clients got a taste of how mortgages actually work and a guy who could distill it very simply, my sales like tripled. And so I thought, oh my gosh, I'm getting much better at this than I was, 10 years prior. And it's never stopped since. I've always had a desire to learn how things work. Call it the Elon Musk fascination of the small details and how one thing going wrong can literally, crash a rocket like that. Those kinds of things matter to me.
Interesting, man. I did not know that story.
That's amazing.
And it's cool because I personally align with so much of that. There's so much to unpack there that I want to touch on, because I remember distinctly for myself, I was in 2012, March of 2012, I shattered my left ankle. Okay. And at the time I had just graduated high school. I was in college. I was playing collegiately on the Oregon State golf team. And at the time growing up, my identity was golfer. That's who I knew myself as in the mirror. Everyone knew me as. That's, when you go to a place, there's always that small talk conversation of whatever people bring up with you. And whenever people would talk to me, it was just like, how's the golf game? There was like, not how are you? And 2012 happens, break my ankle, chasing a girl, of course. And
Literally chasing her.
No, well, I chasing that high school sweetheart. and didn't work out for me. But anyway, so fast forward to, the next fall, where I lose his golf scholarship, move back home with the parents, put on weight because my mom's cooking is phenomenal and there's always extra butter, extra sugar, extra everything she does. And so put on weight, but I'm now in a town that isn't our original hometown. So I'm living depressed and living in this state of lose all my friends, lose my identity. Now I'm out of the school of my dreams, scholarship. Where am I headed? And I'll try and make this a quick story here to get more into you. But I remember at like 3 a.m., I was in my cast and I was on some oxycodone or hydrocodone or something, playing Call of Duty or some football game on the computer, and hobbled over to the restroom. And I caught a glance of myself after falling and saw myself in the mirror. And it was almost like, you need to have it bad. You need to almost hit the bottom to hear someone guess your weight, or have everything hit you in the face in that moment to be able to rebound like a rubber band. Because in that moment, I realized I saw myself in the mirror physically, but I saw myself also inside of who I was, and realized like, I need to be the man that I want my future dream wife and spouse to desire. What characteristics does that person have from an intellectual standpoint, a physical standpoint, and all of those various things, emotional and all those kind of things. And from that moment forward, I Googled gyms in the area, found a CrossFit gym in the area. And from then on out, my drive, my everything has completely changed because of that moment right there. And so I had a choice to make in that moment, and so it's interesting to hear that. And so for you, I guess, what was your previous, so you were working with, was it Bank of America that you were with, or Merrill Lynch?
Yeah. So I started mortgage August of 2004. And I was like you, I had no idea what the word title even meant.
Right.
So started with Countrywide, back then Countrywide Home Loans. And when you're 23 years old, 24 years old, you have no idea all the noise surrounding the company that you're working for, the same company that's literally falling out of the sky as fast as the news can break. But so Countrywide, my first manager at Countrywide said, "Hey, you want to come over and make 10 grand a month?" And I was like, it was so otherworldly kind of money that I said, sure. Honestly, I just wanted to get out of retail because I was working retail. I just wanted 8 to 5, Monday through Friday.
And you were like 24 years old at this time?
Let's see, August of 2004, I would have been 22.
Wow, that's so young.
I know.
But
by then he's got 3 or 4 kids, 3 kids.
I had 2 kids. Yeah. So my second oldest was like 3 months old. And this guy said, hey, we're doing this thing called mortgages. All these young guys are making 10, 20 grand a month. And I was like, I don't even know what that feels like.
Yeah.
But I'll come do it. And like 3 months later, I made my first $15,000 paycheck.
Oh my gosh.
I was like, I'll never do anything else ever again.
I bet family life got a lot easier.
Yeah, but the old adage, as your income goes up, so does your lifestyle. I'm no different to that. Obviously, differently now that I'm smarter. But started August of 2004, got into mortgage. Back then, it was what people don't really know is starting in late 90s. Let's call it the Clinton years. There was this push to expand home ownership, not just into the minority areas, but even amongst, all income and socioeconomic groups. And so I learned this through my West Wing adventures. But through HUD, through other federal agencies, and through Congress, Clinton signed some housing related measures that would remove some barriers. And usually when you hear removing barriers to home ownership, usually that means relaxing underwriting guidelines.
Mm-hmm.
And so that was sort of the birth of the subprime mortgage product, if you will. I wouldn't say the birth, that was the advent of the massive expansion of subprime loans.
Right.
And you didn't have to be a bank to do it. It used to be only banks offered mortgages because you would bring deposits in, lend money out, and that's the old ecosystem.
Yeah.
So Countrywide was very successful. I cut my teeth on subprime. Wish I wouldn't have, but it is what it is. And in that market, I'd say in 2007 really just dried up. And then of course 2008 happened.
Right.
When did you think, like, at what point were you feeling like I could do this by myself? I'm going to go out on my own?
Oof. I always knew that if I could master the art of storytelling and had access to people, I always knew I would be successful. And I don't mean that arrogantly. It's just, if you have even a small semblance of drive to get up in the morning and just do something, we live in a country where you could probably be mediocrely successful at worst, and then hyper successful at best. I'd say it's probably 2010 to where the seed was being planted. And then, of course, 2014, 2015, I moved over to the Merrill Lynch side of Bank of America's lending. So throughout the crisis, if you don't know this, Merrill Lynch was also a big aggregator of subprime loans. B of A got voluntold to buy Merrill Lynch by the Federal Reserve Chair. So when Merrill Lynch was bought by Bank of America sort of became the bank and the lending arm of Merrill Lynch. And so you have all these high net worth individuals working with private wealth advisors, and those private wealth advisors needed mortgage related products. And that's where I came in. Okay. So fast forward from 2012 to 2015, 2016, all that knowledge and experience I had gained on the academic side of things outside of work really paid off in the high net worth space, because when you're dealing with high net worth individuals, you got to know your stuff. They'll smell it a mile away if you don't know what you're talking about. So I probably grew more entrepreneurially during the Merrill Lynch phase of my career. And then a lot of frustrations, what people don't really, well, I shouldn't say this. If you've ever gotten a mortgage from a large bank, even for extremely wealthy people, it is a task of just burdensome nonsense in a lot of ways. And the reason why that is because banks they're governed and they're overseen as banks, not as mortgage lending offices. And the bank oversight is just at a federal and state level, it's extremely onerous. For good reason. We're products of the 2008 crisis. And so I felt like I was giving hell to a lot of really high net worth individuals. And I was like, this is mind-numbingly frustrating. Like, you have $20 million in the bank, and here I am splitting hairs over silly things. And I thought, I can't keep doing this. I mean, I was the top producer in all of Texas for Merrill Lynch. I mean, we're talking $80 million, funding years and $40 million active pipelines. And back then, the way that Merrill and B of A had their ecosystem set up, rightly so, the financial advisors didn't want the loan officer, the processor, the underwriter, the closer. They didn't want all of them talking to their client, because you expose your client to that many personalities and that many sets of knowledge. It's a risk, and a risk that FAs just don't want to take. And so the LO was the sole communication person to the client. And when you take that and the processing, I had to do literally communication, the sales, the processing, the closing, the post-funding. I nearly had a heart attack in, was it 2018?
So you're just drilling your clients for information, and now I need this, and well, now the underwriter says this, and now we're here, and we've reached this point, but now I need this, and that I feel is a bottleneck that becomes quite embarrassing. It's frustrating, it's embarrassing, because it feels like you have potentially a lack of power.
Yeah, and it was all done from fear. When you're underwriting from fear instead of true risk assessment, the experience for the client is entirely different and just frankly horrible. And by fear, what I mean is fear that your loan's going to get audited by the CFPB or by the OCC, and they're going to find this one thing in a file on a $30 million client, and they're going to say, "See, B of A, you haven't learned your lesson yet." And that was sort of this fear amongst big banks. You can't wave a flag that says, "You dummy auditor, they've got $30 million in cash. The letter of explanation about their Old Navy account is superfluous." And that's the kind of silly nonsense I was fighting. And I thought, this is dumb. Like, this is like, I could put up with compliance nonsense to an extent, but this is just dumb.
Mm-hmm.
Was there ever a time where with these clients, and I don't know how many at that time, when you started to when you started to notice the overwhelming amount of pressure and fear that you mentioned, I guess, how many of these clients, these high net worth clients you're working with, either got turned away or frustrated by the situation, ended up going to a different bank and going and moving on? Was there, do you remember a distinct moment where?
Oh, yes.
Yeah. Okay.
Absolutely. There was a seminal moment in the way that loan guidelines were interpreted. I believe it was early 19. So let's call it February, March of 19. And this is going to get kind of nerdy, so just bear with me here.
I love
Please,
it.
But
I'm like, dive in, please.
yeah. So imagine I am a 65-year-old retiree. I'm taking Social Security. I've got probably $600,000 in an IRA that I'm drawing on periodically. In the Fannie Freddie world, and it's still this way with Fannie Freddie, if you've got a $600,000 IRA and you're taking, let's say, $4,000 a month, all you have to do with Fannie Freddie is take the $4,000 a month that they're taking and times it by 36 months or 3 years. And if the balance in the account supports that distribution schedule, your loan's fine. The way that banks were overseen is the banks had to prove that you have $4,000 a month times the life of the loan, which is 30 years. So here you have clients that are in a spot of $500,000 to like $2 million of liquidity on the bank's records. I'm turning them away and they're in their post-retirement years. And the FAs are looking at me like, are you serious? I'm like, yeah, the guidelines were changed. And it was that moment that I started looking for an exit.
Yeah, absolutely. I wonder though, you're going from these really big machines with so much support. And, I've been lucky in that I've been able to work for, big institutions like UCSF, private sector. I've worked for municipalities and city of San Francisco, city government, and I've owned my own businesses. And there is just something, it's hard. It's really hard to walk away from a system. At first it's scary. Then you do it and you're like, okay, like I've got some clients, I'm doing the work. Then you start to grow and you're going, I need structure. All of the things that I had, I don't have it anymore. I don't have a tech department. I got to call QuickBooks. I'm stuck with the Slack shut down. I've got people that I'm working with internationally, whatever it is. And I'm going, that to me is the hardest part. So for you, you found this exit. Maybe this made your actual client relations so much easier because it unbottlenecked everything for you. What did that look like? Where did you start hitting challenges?
Yeah,
when you were on
good
your
question.
own?
So my youngest, Charlie, she's about to be 5 in September. So she was born September of 19. This is right before COVID hit. Mm-hmm. And what did it for me in September of 19, that was the moment that I was like, okay, I'm looking for the nearest exit. There was these brand new high rises here in DFW that were being built, and several of my Merrill clients were buying condos. We're talking like 25-story condos at $4 million a piece.
Yeah.
And so I'm underwriting and getting these loans ready and get them set up. We've got closing in 3 months. There's a lot that goes into like a high rise and then underwriting and all that jazz. And my underwriter canceled my loan. I lost my rate lock and rates had gone up. I mean, I was sweating. I was up till like 3 a.m. for a week straight trying to fix this problem. And underwriting, they just didn't care. They're like, wow, sorry, you were missing 1 page of your bank statement. The loan wasn't ready for an approval. I was like,
oh my gosh.
I can no longer speak common sense into a bureaucracy like this. So this mortgage company just reached out to me in March of 19, and I put them on hold for a little bit. So I reached back out to them November of 19. They flew me up to Chicago, and I saw this entrepreneurial spirit at work in the headquarters, and I was like, I'm in. And so the next day I gave notice, and of course in mortgage, when you give notice, you leave typically the next day.
Oh, wow.
Okay.
So gave notice. November 24th. It was right before Thanksgiving, I think.
Oh yeah.
Thanksgiving. And I was like, I left a $50 million pipeline behind. I left behind some dear financial advisors that I still love to this day. And I thought, I'm going to make this work. I've been talking about this for years. I'm going to make it work. So let's call it December 1st, start date 19. And then fast forward 3 months.
3
we,
months,
we
yeah,
know
4 months.
we know what happened February 20th. In my world, February 20th was a seminal moment of 2020, only because that's when the 10-year treasury, which is like a common gauge of mortgage rates, 10-year treasury dropped significantly. I've never seen mortgage rates drop that much that quickly. And so my phone blew up, like literally, I think I did 50 loans in the month of March.
Wow.
That obviously took the sting out of going out on my own for a while.
Yeah. Well, you entered into an era for your industry specifically that was like booming. I mean, you guys are, I've heard it from so many different people, commercial brokers, agents, just printing money. That era was just a very unique time.
It was, and I will say, for me, entrepreneurially, I had, from December 1st of 19 until that point, I was getting my machine going, like videos, social media, system, finding the right processor, finding the right office space to where it was a nice fit for my clients. And then all of a sudden, boom, it was like, so I kind of didn't even need all that stuff because I was, to be honest, an
You
order
had
taker.
work, you had the clients.
Yeah. And so I go from my best year in 19 ever, making probably 250 that year, to my best year ever in 2020. But here's the thing, 2020 nearly killed me, physically, like literally nearly killed me, and just made a lot of bad moves out of more fear than anything, because we all know the train can only go so long. It's going to eventually stop.
Yes.
And so from January of 20 until September of 20, had my best 9 months that eclipsed the previous 3 years combined. And so I was like, I know this can't go on forever. I'm going to have to eventually rebuild my systems to do it the right way. And then by the time I got to a point where I was ready to get those systems going, I stepped into management, because I literally was, just to be honest, I was drinking a lot because I was up all hours of the night processing my own loans. The frustrations I had in building my business, because the high net worth space taught me to have very high expectations of people, and by expectations, I have very high expectations around your typing skills, your written and your spoken language, your ability to have a coherent conversation with clients. And I just couldn't find the right assistant. I couldn't find the right processor to prioritize those things. And so I, like a lot of entrepreneurs, take that on myself and kill myself to keep my clients from being exposed to things I didn't want them to be exposed to.
In the middle of all this, Matt, I hear, a lot of career developments and what you're going through and making some amazing money and some great career opportunities for you. At any point, you're in the mortgage space, you're in the housing space and whatnot. When did you start actually physically investing either into multifamily or into the single family space yourself as investment properties, long-term rentals, any Airbnbs or anything? Or what, I guess, when did that start to glimmer for you instead of, creating your money-making vehicle? When did you start thinking about your future in terms of, just investing into real estate instead of just making the money from it?
Good question. I probably the end of 22. Yeah.
Oh, wow. So recent.
Yeah. Because January of 22 is when rates started to really go up. And that's when loan activity started to slow. It was still there. I was really busy up until September of 22, but I had always followed Pace. I'm going to say Pace Morby from afar. I wasn't subscribed to his channel, but his algorithmic stuff started coming across my feed. And I kept hearing about sub-2 creative finance. I didn't really know what sub-2 meant. I knew functionally what it meant, but from a branding, I couldn't understand. Like the first 3 or 4 sales calls I spent on the phone with his team before joining was, is sub-2 a brand? Is it a ecosystem? He's like, no, sub-2 is an acronym of subject to, which is a way of doing creative finance. I said, okay, let me learn more about that. And I just thought I wanted to learn more about creative, because there's got to be a way to bridge this glaring gap between the creative world and the traditional world.
Yeah.
We all love traditional rates. We don't like the traditional underwriting frustrations. We all love creative and how you can kind of just chart your own course with creative. I'm not good. I'll be honest with you. I'm not good, and I'm still learning how to underwrite property. I'm really good at underwriting individuals and their capacity to repay debt. I'm just not real good at underwriting real estate, only because just the time that it takes me to
Yeah,
underwrite
totally.
property.
Totally.
I'm like, I could do 5 loans in the times that it takes me to underwrite a multifamily property. So I got into sub 2, let's see, February of 23. So a year and 2 months ago.
Okay.
Oh my God. You and I joined very similar times then.
Yeah. And my goal was to not be a lender. I wanted to find out, okay, I'm probably 20 more years left of good, hard income earning years, if you will. How can I make real estate a part of that? Knowing what I know, because I know a lot about the traditional side. If anybody is set up well to flourish in the creative world, it would be somebody who has a background in just general housing, general finance stuff. And I got into it and I was like, holy cow, this is a lot.
I think everyone goes through that phase of just, you know, I don't know I'm really curious what your impressions were when you first started hearing Pace talk about creative, because I think for me, you know, a lot of it stemmed back from, like, my grandmother bought her first home seller finance. I've had families buy with lease option. But at the end of the day, my dad was a traditional real estate guy, and he worked his whole life to have that credibility, income, debt to income ratio, whatever it was. And so when I brought this up to him, we had these conversations, like, it was just so foreign that it was scary. And it also seemed fake. And it also seemed dangerous and all these things. And and then you buy into it and you're like, okay, I'm really going to learn about this. And then you go through this phase of, oh my God, if I could understand this, if I could really understand how to do this, the leverage and the power that I could harness from this.
Yeah, it really is like, okay, if you're imagining yourself as one of those superheroes and you're like, you hold the power in this hand, this is traditional finance, and then you have the power of the creative and you're like mashing them together. And it's like, whoever can wield that power well, you don't even need college at this point.
You don't. I sat there going, why did I get a bachelor's degree? I wish I would have bought this years ago.
Yeah.
What I learned from Pace in just probably the first 3 weeks was question everything. Not from I'm a skeptic, you're an idiot, I'm smart kind of way, but hey, there's a way to probably get this done.
So true.
And in traditional finance, if you question everything, it serves you well over a long period of time, because you learn, okay, I questioned that and I was right. I questioned that, I was wrong. And so I had built up this internal curriculum of things I found out that I was wrong at and right at. And when I got into this space, it was like the light just clicked. I remember the first time I watched his video on the Morby method. And I remember sitting in my office right here. I turned off everything. And my title company that I use for my traditional like refis is downstairs. I walked over and she happens to be one of the city council members here in South Lake. Smart woman about housing, about title in Texas. I walked over to her and I said, I just watched this 30-minute video. I thought I was a smart guy. I feel stupid. Is this possible? Can you do this? She's like, yeah, we do it all the time. I was like,
wow.
Morby method, seller finance. And I was like, okay. So at that moment, all skepticism ceased. And I was up all night. I was like, this is amazing. This is literally amazing. And so for somebody like me who's been doing this 22 years, if it took me questioning things with the base knowledge that I have, which is probably higher than the average consumer around finance and housing, imagine trying to download that same information and the excitement of that same information to the average homeowner, the average agent who's so used to living in the traditional world, that I thought, for me, I'm now no longer wanting to buy real estate right now. I'm now wanting to figure out how can I merge the creative and the traditional lending space and provide value to the group. And that moment is when I started recording the whole sub 2 lease purchase VA videos. Because a lot of the Carolyn Kane, Tanisha Epps, a lot of the initial newbie calls, I was hearing things like, oh, I've got a solution for that. Oh, here's exactly how I would do that. And I kept getting called on in these videos. I was like, hey, not trying to be arrogant here, but I've been doing lending for a while. And if I were in your shoes, here's exactly how I would do that in that state with that client, with that loan. And people were like, can I reach out to you? And I just started building this sort of not cult following, but this hunger for actually true information.
Yep. I remember that distinctly. There was a moment I was in a live Zoom call. I don't remember what it was, but exactly you touched Tanisha Spencer now. She was in there and there was a conversation involving a client with a VA loan. And she sends a message to you and says, hey, can you hop into this Zoom real quick? We need help talking about a VA loan with this and sub 2 and whatever it may be. You proceed, and the answer to the question took you less than a minute to really dilate to everyone into the Zoom and the person specifically asking the question. But then you proceeded for the next 35 minutes to give almost like a TED talk about the entire lending space as it's related to subject to mortgages, or to rather purchasing homes subject to the existing mortgage. And it was just fascinating and eye-opening, my jaw dropping. I just remember Tanisha going, that's my guy, in the chat. And it was that in that moment for me where I had met you, and precisely, I remember that from then on, any mortgage lending information or questions, you are tagged in every single post. And you get bombarded probably still to this day with questions and various things. And I know for me personally, you've been such a tremendous resource for my acquisitions and what we're doing on our end. I remember we did specifically, we had a client in Spokane, Washington, that he had a 2.1% interest rate on his home. And he was and this actually now talking about West Wing, kind of full circle, he's a JAG in the United States Air Force and was being stationed in Italy. And so his biggest concern was losing his entitlements when he came back. And we sat on, I still have the recording to this day of both husband, wife, you and me in a Zoom. And it was 8 p.m. your time, away from your family, your kids went down, you're in a Zoom with some random person, me, talking to some sellers, going over subject to and VA loans, going over entitlements and numbers and all these things, and just geeking out on it. I mean, just a testament to your character and how helpful you are to not only just the small ecosystem community that we have, but just of you in general, and as to why you're so successful in what you do. It's just so impressive to hear your backstory and hear what you're doing and how much value you do provide to the community, and myself included. And it's phenomenal, man. It's cool to see someone from your background, highly intellectual, super smart, and in the mortgage lending space for 20 plus years, coming in with such a different perspective than small town me, where I'm coming in it to a place where I can purchase more real estate and purchase investment properties. You come at it from a completely different angle and are blending these two worlds. One you've been living in and thriving in, and now you're learning this entire subset and then just killing it. And I'm so impressed. I'm not surprised. I thought you'd been in the community for much longer than you shared, but no, it's amazing, Matt.
Well, I think what was so pivotal for me getting into sub 2 was I can't think probably of a transaction that affects more Americans than their mortgage transaction. We all strive to buy our first house, to upgrade, to buy vacation properties. That's all the American dream.
Yep.
If we could distill the American dream into a phrase, it's becoming a homeowner. That's, what it's known for, or entrepreneurially being wealthy, whatever. But home ownership from a political standpoint has been the sub definition of the American dream since probably the early 1900s. And so getting into sub 2, you've got this world of investors that want to obviously acquire property. You've got agents representing sellers that are going through who knows what financially, or not necessarily anything devastating, but going through a lot of decision making. And then you've got me knowing what all of those people are probably feeling, thinking, and planning.
Yep.
And then being able to wrap a tutorial around all of those emotions and a lot of those planning. I was like, that's what I want to do. I want to educate people, because if I know what I know and I don't share this, I feel like I'm doing a disservice to people. I went to, what was it, a couple months ago when Pace came to Dallas. He was doing like a little tour, and what was it? It was a conference that Dan Fleischman invited Pace to about 2 months ago.
The Aspire Tour.
That's it. So there's 2,000 people from Sub 2, sort of in like a pre-kickoff thing in the Irving Music Factory Arena. I get up and I raise my hand, and everybody else is asking real estate questions. And I was like, actually, my question's for you, Dan Fleischman. My issue is I've got 12 terabytes of educational videos that I've been recording since 2020. And maybe I've dispersed 1 gigabyte of those to the world. He said, I imagine that you have the cure for cancer, and you're sitting on it because you're afraid of how you're going to look on camera. You're afraid of how you're going to sound stupid. You're afraid that all your friends from high school are going to see your video and be like, I know this kid. He nearly killed me in a car wreck. I mean, things like that. He's like, but you're holding on to information that could save people heartache, financial ruin, or set them up for financial success. And he said, it's kind of deplorable that you haven't rolled that out. I was like, thank you. I sat down.
Thank you.
And that was all I could hear. And so that's when I say I love educating people. Here's, I think, the root emotional plant that I think it comes from. It's, I've made horrible decisions in my 20s and 30s that ruined and affected a lot of people. That's a different story. Had somebody told me at 20 and 30 the things that I know now, it would have probably altered my family outcome. And I don't know of any other transaction experience that can alter a family's outcome than housing, borrowing. I mean, the mortgage itself, the $3,000 a month payment that we make from 25 to 65 literally prevents us from doing things financially because of one thing. And so it just touches so many aspects of our financial lives that I had to become a master at how to own it rather than it owning us, if that makes sense.
Completely. It completely makes sense. And Landon and I, we have young kids right now, and we've both gone back and forth on how challenging it is I'm in the Bay Area, I'm in San Francisco, and it's so hard to survive here. It is so hard. And I got lucky. I married a man that bought his house 20 years ago, and I refied twice. In 2020, I got us down to a 1.85 on a very low amount of debt, but still, I mean, our family's outgrowing this house, and we have to build onto it because the likelihood of selling it and dealing with the amount of property taxes and the size home we could actually move into, it just makes no sense at all. Yeah. So, that's coastside California. It's a really, it's a lot of things, but it's hard. So you have all these terabytes of, I can't even imagine the worth of the education in those videos. And what's the plan?
Yeah. So here's my plan. And Pace recommended this last week before the squad conference, was what you have seems to only come out whenever there's a transaction involved, or if a Sub 2 member has a question. Obviously you can give them the information that you need. He said, but how do you scale that kind of 22-year knowledge to as many people as possible without killing yourself? He's like, you can only do so many 30-minute conversations a day. Yeah. And so through his recommendation, literally before this call started, I was researching Kajabi. I think I have like 9 Kajabi logins because I've had 9 I pay for. Well, I've got Gator, I've got Sub 2, I've got Amy Majori, I've got a bunch of other audio video master classes that I pay for in Kajabi. So I'm a student of Kajabi just because we use it every freaking day. But he recommended literally starting a Kajabi curriculum that will outlive me. And so that's what I'm working on.
That's fantastic.
And it's going to include everything from how would I, if I'm 16 years old, how would I chart my course financially around home ownership? And then how would I chart it all the way through retirement and post-retirement? And I've got my framework ready to go. But I mean, I'm going to be talking about products from the plain vanilla fixed rate that's been around since 1936,
Mhm.
Right.
to other products, to reverse mortgages, to interest bearing products that help you pay down your loan faster. I mean, there's so many products out there that nobody even remotely knows about.
Right.
And when I teach on them, the eyes or the light bulb clicks. And so that's currently what I'm working on, is building out a curriculum that will be like a one-stop shop for everything that you should know.
I mean, that's like your life's work. I mean, that's something that you touched on. It's going to outlive you, but I think it's the ultimate way to give back to your previous self in a way. You know, it's so cool to see, having gotten to know you a little bit more, and how much giving you've given to not only me and the community around me, but just thinking of what that's going to look like in the framework, and how many lives you're truly impacting by sharing your knowledge in your head. From starting out watching a episode of West Wing is so cool. It's so amazing. And no, I'm inspired by that. I can't wait to see what that looks like. And that's going to be a ton of work for you, but I know that you're going to put your heart and soul into it, and it's going to come out amazing. And you touched on it there in terms of loan products, you know, very in full transparency, you know, I'm very vanilla when it comes to, I wouldn't say I'm vanilla, because I am doing a ton of subject twos. I'm doing some blends of some hybrid deals, some seller finance deals, interest only loans, various things, you know, but in fixed rates, our home here, our primary home right here, is on an adjustable rate mortgage on a 7-1, I believe it is. And I guess what type of loan products maybe you want to highlight here, or just one or two that are sleeper loan products that maybe your you know, your standard home buyer may not use every day, but maybe the investor that they're wanting to do would.
I'm going to talk about two. And the first I'm going to talk about is a direct response to the traditional 30-year fixed amortized. The word amortized on a mortgage came about to make home ownership more affordable. Because in the world of lending and borrowing and mortgages, as prices go up, and they're only going to keep going up, or as rates go up, or both, which is the environment we're in now, you have this double pressure of rates and price points going up. The only way to make it affordable is to extend the term.
Yeah, those super long-term loans.
The 40-year has made a comeback.
Yep, we're doing one right now.
And so people feel, rightly so, that for me to even have a shot at home ownership, I've either got to make a ton of money and buy something at hopefully today's prices in 3 years. That's not going to happen. Or I have to buy something I really don't want in an area I don't want to be in, because that's within my affordability. The dirty curse word of amortization, in my world, I live in a sort of a double dip. Amortization is great for the undisciplined borrower who needs a set monthly payment based around their budget. But for the other world of lending and borrowing, the amortized word is kind of like a cuss word. And the reason why it's a cuss word, when you amortize something, whether it's over a 15, a 10, or a 30-year period, that product, that amortization, that payment, and the rate becomes an addiction, that if I can just make that payment, I feel successful. And I'm trying to change the calculus or the question to be not, can I afford the payment, but how quickly can I get this thing paid off so I can go do other financial dreams? That's the question for me. So there is a product that CMG Financial created back in 2005. This is a very popular product in New Zealand, Europe, South Africa. And we have, what's the word for making something proprietary? trademarked it, proprietary.
Essentially.
Yeah.
We're the only ones in the United States that have this all-in-one loan. All-in-one, we call it the AIO. Okay. The all-in-one loan is a first lien line of credit. You can call it a first lien HELOC if you want to. But what it does, we have a banking partner and we ourselves, so we're lending the money. The banking partner is servicing the loan. This loan comes with a checking account. Now you're like, why would a mortgage loan come with a checking account? Here's why. If you take your current traditional 30-year fixed loan or 7/1 ARM, whichever you have, let's say you have a $500,000 house and you put 10% down, and now you're borrowing $450,000. Okay. Statistically speaking, you make more in 5 years through your income earning years. Let's call it from the age 27 to age 32. In that 5-year window, statistically, you make enough money or more than enough money to pay off your house. The average person. Now, the reason why most of us don't pay our houses off sooner is because I know if I dump extra money onto my mortgage to have it paid off sooner, I can't touch that equity that I'm building.
Right.
And that's the rigidity of the amortized loan. I love to pay more, but I feel like if I write that extra check each month or each year, I'm sort of saying goodbye to that money until I get into a liquidity event and now I need to pull cash out with a refinance. That's how the traditional model works. So the Dave Ramseys that say 15-year fixed, pay that thing off as fast as you can, I say yes and amen to that, but I would not do that on a traditional fixed rate product. I would do it with the all-in-one. Here's how it works, and it's so cool. This product and the one I'm going to talk about are my all-ins for the next 20 years. You have a first lien line of credit. You can put 10%. You can put 10% down on a primary home purchase. You can put 15% down on a vacation or second home, and then you can put 20% down on an investment. So you can have this product on any of the occupancy types.
Wow. Okay.
The checking account that it comes with, they are inseparable as free-flowing income dollars, rental receipts, whatever income dollars come into your household checking. We all have a household checking account that we receive income and pay bills out of. And then what remains left over in our typical household checking account, we divvy up 401k, IRA, savings, whatever the plan is for this family household. With the all-in-one, literally every night at midnight, the loan looks into the checking account to see, okay, Landon got paid today. Landon got paid $7,000 today. It reaches over into the checking account and automatically sweeps over that money to the line of credit and drops your balance by $7,000. And that night at midnight, your interest is now calculated on your balance at $7,000 less. Okay. Now, if you're a normal person, if you're a normal person, you're like, oh my gosh, where's my $7,000? I got to pay bills next week, or I got private school tuition coming up due. That's the beauty of the sweep checking account and the line of credit have torn down the wall that divides mortgage and household checking functionality. So now Landon gets paid $7,000 every 2 weeks. I'm just making up numbers at this point. If Landon is a disciplined homeowner and makes $14,000 a month after tax, if he's disciplined, he's spending less than what he makes. Let's say after mortgage, bills, grocery, daycare, let's say you spend $8,000 a month and now you've got $6,000 truly left over that needs to go somewhere. You would normally divert it to whatever savings or retirement vehicles that you have been trained to divert it to. The all-in-one keeps that $6,000. So what it's done is it's driven down your expense for interest. It's increased your line of credit borrowing power by $6,000. And so take that event or those two events in a typical 2 payroll month. Now you've got your balance is $6,000 less, $6,000 less, $6,000 less. What you're doing is you're not saying goodbye to the $6,000, never to touch it again. You're, instead of parking it in a 1% savings account, you're parking it in a vehicle that drives the cost of borrowing down substantially over a short amount of time. So if you take $6,000 times 12 months, what is that? $48,000.
Yeah.
So you have just reduced your principal balance by $48,000 by changing nothing of your income earning power, by changing nothing of your spending habits. You're just parking the money in a much more advantageous vehicle for you than just going and putting it on a savings or a CD. Now, over time, typically 5 years, your loan should be paid down to zero. Okay. Now, if it's paid to zero in 5 years, what does that mean for you? Well, it's a 30-year line of credit. It's not a 5-year or a 10-year line of credit like a HELOC
wow.
is.
Yep.
Okay.
Yep.
So now you have a big, fat savings account, credit card. You're mortgage free in 5 years. Now you've got 25 years of borrowing power still on that mortgage. So now that you have no mortgage payment coming due every month, what are you going to do with that extra $6,000 a month? You're going to go invest it. You're going to go put it in savings. You want to buy a vacation home. Well, now you can just write a check for a down payment on a vacation home because you've got this big fat line of credit,
Yeah.
helping to fund lifestyle choices that a traditional mortgage wouldn't let you make.
Okay. So this is, I will admit, I'm following you here, but it is hard for me to unravel my mind from the traditional fixed rate situation. So I feel like I have heard of this loan product from Stephen Hunt, and that he's having his LLCs purchase homes with a first lien HELOC. And he's talking a little bit about this, but he's not explaining it the way that you are. And I'm going, oh my gosh, I've been trying to figure this out and unravel this in my head. And it's one of those things, it's like when you first find out about sub 2 and you're going, wait a minute. How exactly does that work? Because that feels upfront to me. I'm feeling scared and fear that the bank account, right? They're like, oh my God, I'm gonna take my whole paycheck. What? And that's such small thinking. Like that's such small-minded thinking. So I'm going, all right, this has huge potential. Just equity.
It really does. It really does. And where this is different than I know the product he has, and if it's a HELOC in the sense of the word, the HELOC typically has a 10-year draw period. And then after that, if you owe anything, now you're making P&I payments for 20 years. This is kind of like that, but better. There is no 10 years. It's a 30-year literal draw. So you don't have to refinance. You don't have to refinance after 10 years. You can literally have it. Now, can you? If the price of your home keeps going up and up and up, and now you want to touch more equity, yeah, you could refinance in 15 years to now have an additional $200,000 of borrowing power. But where I'm trying to train people, especially the younger crowd, is stop making financial decisions around what's my monthly payment and what can I afford. Start making your financial decisions on how can I be mortgage free in 5 years. Statistically, you have a shot at being mortgage free with this product. The average payoff, obviously, we lend our money on these loans, we service these loans, so we get statistics on financial household behavior. And the average payoff to zero is about 6.3 years on average. Okay. So imagine if you're graduating college and now you're like, oh my gosh, it's my only options to buy a house are, like I said, maybe live with roommates and expand your borrowing power that way, or buy in an area that you don't really want to buy in. And I'm like, stop making decisions around monthly payment, make decisions around how much can my income help me pay off more fast to give me the next 25 years. If you're 30 years old and the next 30 years of your life is mortgage free, tell me how that doesn't alter your financial legacy.
No, it's huge.
Okay. So I'm sorry. I got to go back here. I'm sorry. So you're pitching this loan product. I'm 22. I'm making 65 grand a year. And I'm going, how does this even work with my income level? Like, what is my monthly payment going to be? Can I even afford it? Because you're still thinking about the monthly payment because you're thinking about your income versus the loan. So how do you teach this person that they can afford this?
Yeah. So I think a lot of people, especially the people that are coming out of college, are being saddled with student loan debt. So that's obviously part of the calculus. So maybe somebody who is saddled with additional debt, maybe they need the rigidity of a fixed rate for the first 5 or 10 years. Maybe they need that. So I'm not saying that the rigidity of a fixed rate amortized mortgage is a stupid idea. There's absolutely the right person that is for. But maybe after 5 years of home ownership, where either your income has gone up or you've kept your spending in check, the biggest barrier to successful home ownership is not income, it's superfluous spending. So if you've kept your spending in check and now you feel disciplined enough to where you're like, you know what? I put 5% down on this house 5 years ago, and now I've got 15% equity. Maybe I should refinance into an all-in-one and attack the heck out of my principal, keep my spending in check so that more of my free-flowing income goes to the mortgage. And now I should be mortgage-free in the next 5 to 6 years. You're still 32 years old with a free and clear home that's paid off. And now you can make different decisions with your dollars, regardless of your income. If you're still making 70 grand a year at age 32, okay, great. 70 grand a year with no mortgage. It's a great place to be.
Right.
And so, but there's that piece. There's the early payoff ability. There's the significant reduction in interest. I challenge you, if you're making $150,000 a year and you have a 3% or a 2% interest rate, I bet you that if I give you a 7% all-in-one loan interest rate, I bet you I will save you interest in the long run with the higher rate than you're going to have with your lower rate. Because
Wow.
what people don't understand that, yeah, the rate is somewhat important because that kind of determines your payment. But there's
Right.
also the time. It's the time. If you're looking at the triangle, you've got rate, balance, and time. When you cut off the time, this 8% or 7% rate now becomes 2% because you've only had the debt for 3-4 years.
So
Right.
then in the market we're in right now, then if you were thinking about investing with this kind of a loan, does the purpose or the tool of subject to become less important?
I don't think it becomes less important. I think if I'm an investor, if I've got a couple of properties that have some equity in them, assuming that I'm cash flow positive on those properties, this is me. I'm not making a prescription for anybody else. I would slap an all-in-one or 2 all-in-ones on a couple of my properties to give me a couple of things. To obviously give me a rapid pay down ability, to give me access to liquidity when I need it. If I want to go buy some subject to properties, well, now I've got a big fat ATM credit card that I can use for cash down payments. And I'm not having to go out and raise private money. I think this right here affects more raising private capital than it does the subject to world. Because now I can become my own ATM.
So what happens, Matt, then if, that's great. We pay off the house in, let's say, 8 years. Okay. Now we have 22 years left on a standard AM schedule. And now we have this credit card with the line of credit to go out and purchase other properties, whatever we may do. And I decide at year 20 or 24, whatever it may be, to take that and put $100,000 or $75,000 down on the next property. Mm-hmm. I guess as you only have, so now is your payment for that new $50,000, how is that accounted for such that when you reach that 30th year of your loan, how it's paid off versus?
Can I open up the iPad and draw this out?
Do it, dude.
Please, please. I'm having a hard time. I'm following and I'm going, do I really understand this?
It took me 6 months to wrap my head around this. So
Okay, good.
Let me turn off a couple things, and I'm going to go on my iPad here. There we go. All right, horizontal. So here's how it works. I'm going to go through the logic 30,000 foot, and then the day-to-day, actually how the checking account functions. Okay. Let's see. So imagine this is your typical homeownership experience of a mortgage. You've got day 0, you've got year 30. Okay. So this is year 30. This is year 0. We all start with our balance, at the highest point it's ever going to be on day 0. So let's say you owe $500,000. You know what? Let me go back to the original calculation. You buy a $500,000 house, you put 10% down, you're starting off your mortgage journey owing $450,000. Okay. Let's call this the time. Let's say this is year 1, year 2, year 3, 4, blah, blah, blah. So now you're at year 15, you're at year 20, you're at year 25. And this is when the debt should be not just zero balance, but also released. By law, if we give you a mortgage, we've got to give you an exit at some point. We've got to give you not just a $0 mortgage, but also a lien release, like to where you have no
Right.
debt at all. So the way it works is your balance is here. So for the first year, you're probably, if you're in my previous example, if you have $6,000 left over monthly in free flowing income dollars that are not being allocated to spending, but are currently being allocated to savings or retirement, this $6,000 on a monthly basis is going to reduce your balance so that by year 5, okay, let's say this is year 5. Okay. What's 6,000 times 60 months? So
360.
by year 5, you will owe $90,000. Okay. If you're paying $6,000 a month left over being parked on your principal, by year 5, you'll still owe $90K. Okay.
And that
So-
$6,000 encompasses the actual payment you're already making, not up and above and beyond your minimum payment.
Well, if you're making 14 after tax a month and you're spending 8, in that 8, I'm including your interest only payment for the all-in-one. Okay.
Okay.
Because
Okay.
the all-in-one does have a payment due every month. And I'll
Sure.
explain in a second how that payment is calculated.
So
But
we're
the-
assuming all disposable income is going back into this loan automatically.
By nature, automatically, but still 100% touchable for whatever needs you have.
Right. Because it's a bank account.
It's a line of credit, bank account, and the barrier between the mortgage and the line and the checking account is now torn down, and there is no barrier. Move money freely between the two. Okay.
Okay.
So all 6,000 a month left over is going to the mortgage, and now you've dropped your balance. Oh, crud! I just did that. You've dropped your balance from 450 to literally $90,000 in 5 years. Okay. Now, until year 10, let's say this is year 10 right here. Okay. Until year 10, you have access to touch all 450. Okay. So if you owe 90, you can literally go out and write a check for $360,000 if you have a big emergency or a big need. And now your balance has gone from 90 back up to 450. Okay. And you sort of start that over again, if that makes sense. People don't usually do that, but it's possible. So now at year 5, you owe 90. Probably by year 6.5, you're probably going to be at a zero balance. Okay. From year 6.5, when you're at zero owed, until year 10, you have access to the entire 450. Okay. You can do a couple of things. You can refinance if you want to. And if your house has grown in value, which it probably has, well, now you can borrow more than 450. You could maybe borrow 600. You don't have to, though. That's the whole thing. You don't have to refinance if you don't want to. Starting at year 10, we have to give you a stair-stepped down approach to your borrowability. Okay. We don't want you at year 27 to be able to touch $450,000 and only have 3 years to pay it back.
Right.
Okay? So in creation with auditors and compliance and federal oversight, starting at year 10, we cut your borrowing power by 1/240th every single month. So what that means is we take 450,000. My battery literally just died on my calculator.
I got it. I got you. 450,000 divided by 240.
Yep.
1,875.
So $1,875 is what your borrowing power is stripped of every single month until year 30.
Okay.
So-
Makes sense.
By year 40, I'm sorry, by year 15, Landon, what is 1875 times 60 months?
$112,500.
So by year 15, you can no longer touch 450. You could touch 338. Okay. So 338K is now what you can touch at year 15. Year 20, same mentality. Year 25. And then by year 30, it's completely zero. Okay.
Do you think this is like better for people that are doing homestead stuff, like young? I'm buying my first primary home. Like this is better for that purpose, or do you think this is like who do you think this is the best loan product for?
Number one, cash flow disciplined homeowners who live below their means. Because if you have, in Landon's case, in my example before, if you make $14K a month take home,
Mhm.
7K every 2 weeks, but you're spending 13.5, that's not a win. You will not pay this loan off in 5-6 years. You'll pay it off in 29 years.
Yeah.
So I say cash flow positive is the first thing. And then if I'm a homeowner, let's say I'm 22 to 25 years old and I have some equity. I had a college graduate come to me about 3 months ago. Dad owns a home free and clear for $300,000. And he's like, how can I give this property to my son? I was like, I would gift it to him through a normal real estate purchase transaction and have your son get an all-in-one loan. Your son's literally walking into $300,000 of equity. So the dad's like, I don't want any money from this closing. I just want to give him a property that he can live in and now use as an investment or equity vehicle. And so for somebody like that, even though they're young, they're walking straight into equity. So cash flow positive, disciplined, and or walking into some equity if they're young.
Got it. Okay. This
If
is
they're
good.
not, let's say they're living by the skin of their teeth because student loans and just the cost of living is expensive and they have no positive cash flow. Maybe for somebody like that, a rigid 30-year fixed or 15-year fixed is the best route until the muscles of discipline kick in and they pay off debt or they pay down debt and there's some breathing room there.
Mhm.
So then say in this example here, at year 6, we paid off the house. So from year 6 to 10, we have the ability to tap into up to $450,000.
Yep.
Let's say we write a check for $450,000 in that moment. You're saying after year 10, our ability to borrow reduces by $1,875 every single month until it's liquidated. But I've already written a check for $450,000 on a down payment for these cool Cabo cottages now that I'm going to go stay in. But how does that work when I've liquidated all of the equity out of what's left over?
So there's still a monthly payment that's due.
Okay.
So in this example, if at year 10, now you've got 20 years left and now you owe 450. So now what happens? So your interest is still calculated every single day on what you owe that day.
Got it.
What I need to show you is how the interest actually works and why this is very different than an amortized loan and why doing it this way is what allows that faster payoff. Okay.
Got it.
So in a traditional month, I'm just going to do my best to draw a calendar here. Here's how most Americans live this way. Literally this is Friday. I get paid here and I get paid here. Okay.
Mhm.
So what happens is every day your mortgage is calculating interest on the all-in-one mortgage. The interest calculated is whatever the balance is times the rate on the note. Okay. So in the previous example, I just quoted a client today, 7.76 on this product. So let's say 7.76 is the rate in question. Okay. And let's say you owe 450. Okay. Every day this month, nightly, it's actually nightly at 12:01 a.m. The system takes what you owe and times it by the interest. So Landon, take 450 times 0.0776.
450,000 times 0.076.
0.076.
34,200.
Divide that by 365.
$93.69.
So today, $93 was your nightly interest calculation. And it'll be that way until your first paycheck comes in right here. Your first paycheck comes in. Now you owe 454. If 6,000 is left over from that paycheck that's parked on the account, actually, no, that's not true. In this case,
It'd be plus the interest.
well, in this case, if you get paid $7,000 on a Friday, 7,000 goes into the balance, and now interest is calculated on 443 that night. So instead of $93, now your interest is $86 roughly. Just throwing a number out there. So the next day, interest is calculated at $86, $86, $86, and then all of a sudden you got to pay bills the following Wednesday, and you draw another 4,000 out to pay whatever. Okay, and so now you owe 447. Okay. The interest changes here, the interest changes here. So at the end of 30 or 31 days, it takes all these days and adds them up, and that becomes your interest only payment due on the 21st of every single month. So as you're driving down the balance, as you're paying bills, this activity is building up to where your balance is slowly falling over time. Your daily interest is falling over time to where you start getting like this snowball effect, and the debt starts rapidly getting paid down. And at the same time, expanding your borrowing power all the more.
I love this.
So
This is great. You're so spot on with your ideology of that.
It's like a savings account without the illiquidity of like a CD or a money market account, because a money market or CD, it's pretty illiquid until you make a request for it. You've got the rigidity of a retirement account. I love 401ks. You should invest in your 401k because it's free dollars from your employer. But if you're doing post-tax IRA contributions, maybe you should do this instead, because the interest saved on this sets you up for gargantuan wealth earned in your later years.
Right.
If I can save 6 years, which is hundreds of thousands of dollars in interest, even your 2.5%, $400,000 mortgage over 30 years is costing you like $220,000 in interest. Like, I don't care what your rate is. It's over the time factor is what makes that 3% rate not cheap. So if I can condense your time, this 7.76, if you pay your loan off in 6 years, your effective, this is a big word that nobody really knows to ask about. It's called your effective APR. This is your actual rate. This is your effective rate. What did I actually spend in interest over 6 years? In this scenario, it's about $86,000 in interest over 6 years. That translates to an effective rate of like 0.73%.
Oh my gosh.
Does anybody have a mortgage for 0.73%? No.
No. So can you refinance a HELOC into an all-in-one, since all of these HELOCs have like been like I've seen with variable rate HELOCs, they're stuck at 8.5 now prime.
Yep.
So would that make sense?
I think it depends. The answer to the question is, from a rate standpoint, the Fed has direct oversight into the federal funds rate, which affects the prime rate.
Sure.
The index that drives the all-in-one loan is called the 1-year CMT. And it is based on inflation expectations, but the Fed literally does not have a light switch for this index like they do for the prime rate.
Right.
So this whole noise about the Fed possibly cutting rates this year, that noise has subsided, and now there might be some rate increases to see if we can drive down inflation. So while the APR on HELOCs has gone up and up and up, the all-in-one has gone up, but not at the same clip and not at the same pace. But this is where I tell homeowners, stop asking me about the rate. Start asking about your free-flowing cash. Because if you pay this thing off in 6 years, you're not going to care one dead gum about what the rate is.
Sure.
Wow,
Sure.
that's the Texas coming out at me.
That was Texas, right?
That's amazing. I love it. Thank you so much for going into depth about this. This is really, really, really powerful information. I can't imagine what your Kajabi course or program is going to possibly look like based on the last hour and 15 minutes.
Well, so now the second product that's part of my mission, this is a mission I'm on, is okay, I'm Landon. I take out this all-in-one loan at 30. I'm mortgage free by 37. From 37 to 57, those are historically speaking, my formative income earning years.
Mm-hmm.
I can live my life without the burden of a mortgage, but with the freedom of a big fat ATM if I need it. You're sending kids to college. You're buying a vacation home. You're putting parents through medical facilities at this age. So how can I help my aging parents have access to this awesomely appreciating asset? And this product, literally in my world, this changes the financial discussion. I've even tried to reach out to the Ramsey team to say, you need to talk about this. You
100% agree.
You debt-hating people, like there's no greater vehicle for debt hating than this. And I hate bad debt. I love good debt. But imagine doing this for your 30 years old to 57, 60-year-old formative period. And all of a sudden, now you're retired and you still don't want to lose the big fat debit card that is your house, but you also still don't want a mortgage payment. And that's where the reverse mortgage enters into the equation. People have bad juju from reverse mortgages. And I don't know why. I think it's an education thing. If I'm 62, if I am free and clear, or even if I have a balance on my mortgage, I am going reverse mortgage and I never have to worry about a payment ever again. So yeah, that takes a lot of time and education, and like laying awake at night. How do I even digest this in a way that affects my family?
That's the big part. That's the big part, you know? Oh my gosh, it's absolutely overwhelming, but it's also really, really, really exciting. And I wish I knew this when I was 22.
Yeah.
I wish I knew this when I was younger. And, you know, now I'm at this even like 4 years ago, where it's one kid less, way more disposable. And this makes so much sense.
Yeah.
So much sense.
You just needed to watch West Wing, and that's where it all starts.
No, I need to find Matt Bell. Thank you so much for talking about this with us, Matt. Like, this has been like, this is a gift. This is fascinating.
It is. Like, so if I'm now in the creative world, like Landon, Pace, Molly, whoever, I know we are a creative world first, traditional way, third, fourth, fifth. I still think there's ways to marry the two to achieve even greater wealth and real estate acquisition.
Well, this is very creative. This is substantial. I mean, this really is. And if you're in a place where you have any sort of disposable income, like, this is where this comes in. And I think that's where everyone's trying to get with cash flow and their investments, you know, whether you're taking yields from short-term rentals or fix and flips or whatever it is. I mean, this is where a lot of that extra money goes.
Yeah. And I think even for people that are seasoned investors, and I don't mean real estate investors, but just seasoned mid to late 50s, when I have this discussion, I spend more time overcoming, but the rate is higher. And these are smart people that I'm talking to, but the rate's not 2%.
Yeah.
I'm like,
it's the time. It's the time.
People don't understand that the triangle works the same way with debt that it works in investments. With investments, if I invest $450,000 at a 2% rate of return over 30 years, that's going to be a great return, not because the investment rate of return is great, but because the time is great. People don't understand how to flip that equation into the debt picture and realize that the rate's high, but it's only as high for as long as you have the debt. And therefore the effective APR, people don't even know what the word effective APR really means until you show them. So we have a calculator simulator online. I walk homeowners through and I'm like, okay, here's your current mortgage. You owe 500, your rate's 2.5%. This is 7.75. You're going to be mortgage free in 6 years, and you're going to spend $200,000 less on my mortgage than your current one. They think it's a trick. They think it's a trick.
That's trippy.
That doesn't shock me at all, though. That doesn't shock me at all that people think it's a trick. I mean, it's really hard it's really, really, really hard to walk away from thinking the way that we've been taught to think around a lot of these products and purchases and transactions. And I think that's why, you know, the sub-2 community is so unique, but it's also easily attacked. And, you know, unless you're really proficient, when you're just really one of those folks in that community that's not actively doing transactions or deals and working with these products, it's really hard to talk about them in a way that makes sense and is believable with confidence. And I still believe it is a sophisticated tactic. I still believe like sub-2s are really, really the most amazing for people that have credit, that have, you know, money, because then you can really, truly, truly scale. I mean, then power truly becomes limitless in this very, very exciting way. But being able to utilize products like this too is just, I'm really excited. I mean, here's a good story. I've had
3 people in sub 2. These are people that have W-2s, but they're also full-time investors. Multiple. So of these 3, they had multiple properties, some sub 2, some traditional DSCR type financing, whatever. But the 3 investors that came to me out of sub 2 were like, how can I utilize this product on properties that I own subject to that have a lot of equity? And I'm like, that's a great question, because I wouldn't be so married. And again, this is a case by case basis. This is not a flat statement. If you've got a 2.5% sub 2 mortgage and your property's cash flowing, why would you want to upset the apple cart in that situation? And I'm like, that's the obvious question. But how much equity are you sitting on that you can't touch? Because it's hard to get second or third lien debt. It's not impossible. It's just hard on a sub 2 property when you don't currently own the first. The first is somebody else's that you're making payments on. I have done HELOCs for people in sub 2 or Gator in second position when they've got a first lien sub 2 debt. So I'm not saying it's impossible. It's just difficult. So if you have a property or properties that has lots of equity, but the debt's really sexy on the sub 2, don't overlook something like this that can open up the ATM to you and go do other bigger things. So that way you're not paying 10, 12, 15% on your private money and the stress of acquiring private money. It's just another tool to have in the tool belt.
I love it. No, that's a conversation that you and I need to have, because I am that person you're speaking of. I have 8 properties now, one of which I purchased that I own as a short-term rental property for us that has a 2.9% interest rate. And we have probably $350,000, $400,000 of equity just sitting in that property that I can't touch, And so this is something certainly you and I'll talk offline and explore. And I can't wait to talk more about it and whatnot. But Matt, thank you so much for hanging out with us today for a freaking hour and a half and exploring your background and really your origin story and how you faced adversity self-admittedly to become who you are. And I think that's a message for everyone here, is that they should be inspired by you and your journey. And we want to thank you for what you went through to be who you are now, because how much value you provide the community, myself included, Daniela included, everyone else, and what you're putting together now is a fruit of all that adversity you faced. So thank you for going through the adversity, whether you wanted to or not, and forcing yourself through there. And I'm just so grateful for you, and to call you a friend and to have you on your first podcast with us. And I'm honored. So thank you.
Thank you guys. And Daniela, thank you for having me. I'm not sure if I have the floor for parting words here, but
yes, please.
These are my parting words. What people don't understand about me, and I don't talk about this just because I don't really have time to. When I was about 21, I went through probably the most formidable depression I've ever been through. I mean, you go from being a happy-go-lucky extrovert to literally the next day, I can't even get out of bed because I'm so terrified. I was terrified of flying. I was terrified of the caffeine making me have a heart attack or a brain aneurysm. So that was my world for 8 years, going through learning this stuff. I mean, there were days I literally thought that I had written suicide notes to my kids because I didn't know if that was going to be the last day on earth. And if anything, I've learned, and God has been so faithful to teach me this through my own painful, stupid decisions and through other pain heaped on me. It's when you can't get up the next day, or when you can't see a way through, there is no path of success without other people checking up on you, other people holding your hand. I am the beneficiary of some amazing, loving men and women in my life who have seen me drowning proverbially and have reached and literally pulled me out of the muck. And I literally owe my life to about 3 wonderful men that they didn't give up on me. They literally didn't give up on me. And so I've got a passion for a lot of like young men that are in this phase of life of, I don't know what I'm going to do. I've got a young married wife. I've got young kids. I'm overwhelmed financially. I don't know what to do. And I just want to rally around young men like that and give them a clear path forward. And that's the passion and the mission behind this.
Oh my gosh.
Thank you, Matt. Really, thank you. There's a lot of people, a lot of people that need to hear that, and especially a lot of people in our community and surrounding communities, and we're all struggling. That's why we're there. That's why we bought the ticket, because we knew we needed a path forward, and we're just trying to figure out what that is.
Yeah.
So
And this community, I call this the sub 2 is like the nexus of all these other creative communities I'm a part of. I have met more wonderful people, you guys, Pace, Molly, people that we esteem as really successful. I've actually gotten a chance to talk to those people on the phone. I'm like, you're just like me.
Yeah.
You were successful out of either a bad time in your life or whatever. And I'm really grateful for Pace and Molly and the whole leadership team at Sub 2. This community has literally redirected my life.
Beautiful.
So that's it.
Beautiful,
That's my life.
I don't even know how to end it. I'm like, thank you again. And I hope you have.
Open up your hymnals to page 500. Here we go.
I know. I hope you just have a lovely weekend. And I really can't wait to share this one with the audience.
Awesome. Thanks, guys.
Thank you.
All right, bye.